Welcome to this segment of GTM Training Shorts presented by GTM Training Institute, your source for comprehensive income tax compliance and tax provision learning and development. My name is Frank Nieves, Director and Practice Leader. Corporate tax can be complex, and understanding its terms and concepts can be challenging. GTM Training Shorts aims to simplify complex content into concise and comprehensible segments. In this short, we will address the question, how do stock acquisitions and asset acquisitions differ for tax purposes? Listen to Ed Coleman, Managing Director in our lead tax practice, as he explains.
Hello. I'm going to walk through the different types of acquisitions, and one's called non-taxable and the other's called taxable. And I'm going to pull all of our sub-bullets up on the page here, and we'll walk through. So you have a non-taxable or stock acquisition, taxable or asset acquisition. In the tax world, it's always important to get things classified. And once you get it classified, then you can go through and compare the different effects. And tax doesn't always necessarily run parallel to what book classifies things as. I look at a stock acquisition as it says non-taxable, but keep in mind that there's a level of taxation outside the corporation. And in an asset acquisition, the tax is generally inside the corporation. So as these bullets point out, there's no taxes paid by the acquiree or target at acquisition. So that's inside the corporation because it is being sold. It's not selling. It's, I'll say, insides or guts of the corporation. The selling shareholders are taxed on the difference between what they get in consideration and their tax basis in the shares. Again, looking at the outside of the box. And the tax basis of assets and liabilities carry over to the buyer. So there's no step up within the corporate world because there's no gain or loss that's that's happening within the corporation. And subject to limitations, and there's a number of them, tax attributes are transferred with the target company. So your typical one that everybody thinks of is net operating losses, but any kind of losses or credits or other attributes come forward. To counter this on an asset acquisition, it's where a corporation is selling its machinery or its tables and chairs and whatnot that it owns within the company, and taxes are paid on the gain or loss of those particular assets. And the shareholders of the selling corporation are then taxed a second time when those proceeds net of taxes are potentially paid out to the shareholders. And with the tax being paid, there's a tax basis step up. So you get the step up and you do not get the attributes. So really the main thing to keep in mind is who's taxed and then whether or not there's a step up and no attributes, or there's no step up and you get the attributes. So this is an example of using the same proceeds of $500,000. So in a non-taxable stock acquisition where the shareholder's going to be taxed, the proceeds are paid to the shareholders, not the company, because they're the seller. And you look at the basis compared to the proceeds. In the example, there's $5 per share that the shareholder's getting. And so Joe Smith, in this example, gets $500,000. He paid $1 and has $1 of basis and 100,000 shares. So the gain is $400,000. Company A is outside of the mix. It's really like the box being moved over. It's not recognizing the gain or loss. And that's why, as I said, it's called non-taxable. In an asset acquisition, it's proceeds for the net assets or the inside, the machinery and equipment and land and buildings and you name it within the company. So company A is selling its assets inside the company in the right-hand side here in the asset acquisition, and it recognizes the gain on the difference between the proceeds. And for convenience, we used 100,000 basis as if it has 100,000 basis remaining in its machinery, equipment, etc., that it's selling. And obviously, it doesn't need to be all of its assets each time. It could be a subset of its assets. In this example, for simplicity, we're saying all the assets. And then once the gain happens and there's tax at the company level, company A gets the proceeds, the resulting gain or loss, and then it's taxable, and then it goes out to the shareholder. So this this slide here gives a great summary of the comparison of the two different types of purchases, stock versus asset. And so the as we work our way across shareholders basis, and the stock purchase is the fair market value. Asset, it's not applicable because it's inside the company. On the inside basis, as it transfers over in each of the transactions, the stock purchase is historic, no change in basis. And then for an asset purchase, there's the step up because the old target corporation is recognizing gain or loss. Um, Outside basis to the buyer is the acquisition day fair value for the stock. In an asset purchase, it's not applicable, again, being inside. And we've covered the recognition to the target that it only occurs for a taxable asset purchase. And tax attributes. So when you're going through these transactions and you're modeling, the attributes are a big deal. It's the step up. Is that important to you as the purchaser, or is the attributes more important? And you need to assess between the stock purchase where they're transferred and the asset purchase where they're not transferred and remain with the old target.
For more information on the U.S. tax compliance and income tax accounting issues related to business acquisitions, please visit our website to learn about our various compliance and provision programs. You may also contact me via email for additional information or to suggest a future topic. Don't forget to like and subscribe below. Thank you.